about 3 or 4 years ago, we did a lot of investment events just orientated at kind of experienced investors and found them really, really useful. And they did very, very, very well. And then really we sort of didn't give it a go because stocks and shares kept going up in price. And we thought, gosh, I mean, why be talking about it? Why don't we just sort of be dealing in shares and that kind of stuff? So we didn't do the events. And we thought we'd do this event this time because the one thing that I've been writing about for the last, year and a half, 2 years, is when is there going to be a turn in bond prices? Come on, something must happen sooner or later. And if I got paid £1 for every time I'd written a column about, for Investment Week, say, about now is the time that bonds are going to crash in value, I'd be a rich man by now, because every one of the bond turning points never ever happened. And here we are, we find ourselves in freezing cold London, Covent Garden in November, maybe at a turning point for bonds. Certainly I think some people in our panel today think so. So we thought it'd be interesting to do a discussion around bonds because it's the great imponderable, everybody sort of wonders in portfolio terms what we need to do. And I think, and we'll talk a bit about it today, because of course we're at that point where interest rates are starting to go up. We're at that point where people are beginning to think maybe we are at a point where quantitative easing is beginning to sort of dial down. And maybe we are at that turning point. Well, we'll find out. So we've got a great panel here, all of very different kind of backgrounds. I'll start with Steve first, certainly the loudest. And Steve tells me that he first got interested in investing when he was 12 years old. Most of us are interested in other things at 12 years old. But because he saw George Soros probably doing over the Bank of England. Was that the?
Well, a bit before that, but that was my big.
Yeah, it was good. Yeah, okay. So decided that, and then basically went into the I must run a hedge fund. Now, that's probably quite a good idea. I'm sure lots of 12-year-olds at that point were thinking about I must run a hedge fund. My 12-year-old certainly was thinking at that point, and then basically ended up going to work in banking. Went over to New York. And then came back to the UK and is now running Rubrics, which is a partnership with Shard, looking at fixed income investing. I'll hear a bit more about that later. Now, Kevin, I'm pretty sure I sat down with Kevin many years ago when you were at Brown Shipley, wasn't it? And you were a bond manager, very successful bond manager, weren't you? Yeah. And I remember, I'm sure I asked you a question about, is it about time that bonds started selling off? And you probably went, no, it'll be fine, and you were right. They actually probably did very well. And then you went to Kleinworth Benson, KBC. Is it
KBL.
KBL, sorry, I always get that mixed up. KBL. Yeah, exactly, yeah. And now is with Chief Investment Officer and COO, is that right? MD at AJ Bell, the vast mega core that is Andy Bell's operation, doing very well over in the kind of tax wrapper market. So I've known Kevin for a very long time. Kevin is never short of an opinion on bond investing. And I think we'll get, again, like I said, we've got really kind of powerful views. And I've known Martin for many years as well. So Martin was a central banker. And and then basically got brought to the dark side, or the other way around. And then his wife brought him over to London, can blame her for that, and works for a small ETF firm called ETF Securities, which just happened to have a transaction yesterday, got taken over by Wisdom Tree, isn't it? For a not inconsiderable sum. And actually, ETF Securities is interesting because they've been pioneering something which we will talk a little bit about a little later, is about the idea of fundamental indexing and bonds, which is an idea that time may become. And what we're going to talk a bit about this evening is 3 or 4 things. We're going to talk a bit about, I'm going to be a bit radical. I maintain that we're in a very low rates environment for much longer than we all think. We're going to talk a bit about inflation. We're going to talk a bit about how do you actually implement, because a lot of people have to run a fixed income allocation. They don't have a choice, really. And they've got to do something, yeah, even though rates are low. So what the hell do they do? Where do they find value? Where do they find yield? Do you find it in active management? Do you range internationally? Do you go across sectors? What do you do? I mean, it's a classic question. Do you go up the risk curve? Do you do any liquid stuff? What do you do? It's an interesting question. A lot of people got to do it. You know, they've got fixed allocation to fixed income. They've got to do something. We're going to talk a little bit about, after I mentioned earlier, but inflation. I think inflation is a really fascinating subject. Is inflation nigh? Again, I maintain quite strongly it isn't. It's all an illusion. I'm sure I'm going to be violently disagree with me. And then we're sort of really just going to talk generally at the end about where does central bank policy and bonds go at the end? You know, and we're bound to mention things like helicopter money. You know, when the next recession comes along, there's something big's coming down the track. So we're going to range quite wide. We are going to be quite practical as well, because we've got actual people who do either set up funds or actually manage funds, or chief investment officers here. So they've all got to actually deploy money. And our audience is deliberately kind of sophisticated. We've gone through a lot of people who work with advisors and high net worth clients, so that it's a kind of higher level of debate about what's going on. So we're not going to make that active assumption that, if bonds can be better than savings products. Yeah, anything can be better than savings products. So we're going to talk a little bit about how we actually implement that strategy. So if that all makes sense, and then we are going to take questions at the end. And if you do violently disagree with anything we talk about in the panel, put your hand up and say. So it's really relaxed in that respect. So let's kick off. Now I did an investment bank event about a year ago, and it was a series of bankers, and I use my words guardedly. And they basically, it was banking analysts, and we asked them when they thought interest rates would go above an average, rolling 2 or 3 year average of above 2.5%. And of the 44 people that were answered the question electronically, only one of them answered one way. The other 43 went never. It would never go above 2.5% on average. Those days are gone. And then I sort of asked them when they felt that interest rates would average above 2.5% if they had to give a date, a date in the future. Now I was expecting kind of 2021, 2022, and it was actually 2047. And even then it wasn't big consensus. So they were of the view that it would be a 30-year low rates environment, which is the argument behind my low rates longer argument. Yeah, we all accept interest rates are going to go up. They obviously are. And clearly the Fed has signalled 2 or 3 more, I think, probably in the next 12 months. So that goes without disagreement, yeah? So we are going to get to sort of 2.5%. And then we'll be in a recession and interest rates are going to come straight back down again. And we're going to be stuck in this Groundhog Day scenario, aren't we, gents? Where interest rates go up to sort of 2%. Central bankers get it to 2.5%, and then they bring it right back down again. And then we're back into this scenario again. In that environment, fixed income still has its attractions, lots of attractions actually, but they don't look as good compared to equities, which just keep doing this. So is my low rates longer argument valid, do you think, or am I speaking complete rubbish? Go on.
Go ahead, Steve.
Well, that answer, there was about a 2-hour answer to that one, but I won't give you the 2 hour.
Yeah, give me the 2-minute answer, yeah.
The 2-minute answer is, we don't know because we don't know what the policies are going to be. We just talked about a few minutes ago. Did we think we'd be where we are 10 years ago now and what they did?
Yeah, because actually before we came on, we always said, you sat down 20 years ago and said interest rates would be this low, quantitative easing, balance sheets, central bank, you'd all laugh, wouldn't you?
We'd say, mad. Now, can they continue that? And your argument would be absolutely right if they continue doing what they're doing now. But it might not be possible. And there's lots of reasons why they might not be
Why might it be possible?
I think, look, there's lots of different ways how countries fund themselves. So if you look at the likes of Japan, being able to stabilise it for much longer because basically they're able to support that system through its own savings. The UK, for example, the US don't have that same mechanism. So eventually they will run into a brick wall a lot sooner than the likes of, for example, Italy or Japan would. But I think ultimately they're going to lose it because of political pressure. And I think these
from where? From who?
Political pressure. It's massive already.
But there are lots of people going around going, I must have interest rates up to 5%. Oh, well, there are a few, but not yet.
No.
Not yet. Okay. Yeah. Okay.
But the point is, under your premise, you're saying things stay as they are. I'm saying is if things continue the way they're going, you are going to have Jeremy Corbyn running the UK. You are going to have the far right doing better in things. We'll be looking back at Trump and looking back fondly at he was a great president compared to the guys that we have now. So we know historically every millennium, when this comes to an end, it always ends from a political crisis. So it starts with a debt crisis, goes to an economic crisis, goes to a social crisis, which we're seeing today, and ends up in a political crisis. And then, of course, that's when you get into, as we discussed earlier, the central banks are no longer central banks, governments take over because they're not doing, everyone's disappointed with low growth or they want to fund the next project or whatever happens. So to predict where interest rates are going to be, you have to be able to predict what the political scenario is going to be over the next 20 or 30 years. And again, if I told you Brexit would have got voted, Trump would be president, you would have gone, Steve, you're absolutely
okay, so let me challenge that though, because I said, I as a columnist, I love writing about politics and investing, but I've now been burnt. So I remember predicting that Trump got in, stock markets would collapse by 20%. Actually, Marco Rubio said that, the other guy, the American billionaire, and it didn't happen. Shares have gone up. And I've slightly come to the view that politics don't really matter, and they go in, they go in these cycles. And effectively, what really matters is that a global debt mountain. Yeah, we all seen the McKinsey's numbers. the amount of accumulated aggregate global debt is huge and growing bigger every year. What matters is that the electorate is hooked on low interest rates. Their mortgages are all linked to low interest rates. Okay, I don't understand where's this argument for suddenly increasing interest rates to 5%? We can't afford to pay for it.
Democracy. Okay, so you're right. It's pointless looking at economics unless you also look at history.
Agreed. Yeah.
And you look at politics.
Yeah.
So from a political point of view, what we'll have and what we're witnessing at the moment is a huge reallocation of capital.
Yeah.
The reallocation of capital is starting
or arguably misallocation of capital. Yeah.
Oh, it's the biggest misallocation. It's the biggest misallocation of capital in the history of mankind. But we're seeing a reallocation of capital within society from savers to borrowers.
Yeah.
Until eventually you come to a tipping point and you end up with a democracy where there's more now savers than there are borrowers in society. And that's the point when you'll see the political rally against the.
So but hang on, just change that. But when is this more I don't know many young people who can afford to save because, and if they do say they have to save for a specific functional purpose, get a deposit on the house. Savings rates are going down. I'm not disagreeing with that, but I'm being the devil's advocate here. Where's this pressure for interest ever going to come from? It's not going to come from young people because they benefit from low interest rates. Actually, the older folk have benefited from low mortgage rates, so their house prices have shot up. I don't understand where this demand for higher interest rates is going to come from.
It depends how they deal with the debt overhang. Okay, so
agreed.
At the end of the day, it comes down to, and it's a very subtle point, what leads debt? Is it interest rates are led by debt or debt led by interest
Good
rates?
Point.
And the bottom line is, actually, if you look at even the UK and the amount of debt we have today, the cost of servicing debt has been pretty steady over 30 years. And what's happened is the system has allowed a massive growth in debt levels because they keep reducing interest rates. So the higher debt level is, the lower interest rates have to be, not vice versa. So the amount of debt system you have in the system determines where interest rates are. Now we know from the 1950s and 60s, interest rates will not go up until our current debt levels are down about 30%. And we've seen that historically. So if you want to predict where interest rates are going to go, you know they're not going to go long term. Certainly in the short term, they can spike up because of a PPI number, the CPI number, and everyone panics and all the rest. But the reality is they have to come, as you said earlier, revert right down. So you look at the debt pile. What is the debt pile? The debt pile is actually US dollar debt because the reserve currency of the world. Yep. And if you look at history from basically 1400, right? Exactly every 100 years or so, we end up having a reserve currency change. And why do reserve currencies change from Portugal to Spain, to the Netherlands, to France, to the Brits, to the Americans? Why do they all change? Because they very fundamentally change because they no longer could provide credit for the rest of the world. Right? So the US are now coming to the point that they cannot provide credit for the rest of the world, so no one wants the US dollar. So what's the likelihood? There's no yuan going to be reserve currency, there's no euro going to be reserve currency, we're all aware of that. So we do know there's going to be an alternative. What's going to end up happening is the US are going to play with tightening their pockets and not provide as much credit, means the dollar will actually ultimately rally, which will be the end of the dollar as a reserve currency. And the debt pile will get washed away with this changeover in the reserve currency. Now, I don't know when that's going to happen, but if we're going to predict out to 2048, I'm going to say there's a fighting chance that by 2048, if you're seeing the speed at which the dollar is being used less and less as a trading currency, there is a fighting chance that we could have a revaluation of this. And basically, guess what? Press the reset button, it's gone.
So when you say 30% lower, you're talking debt to GDP?
Yes. Oh, yeah. Debt to GDP has to go 30% lower before interest rates go up. But we've seen that. You can go back, 300 or 400 years of economic data, and that happens over and again. I mean, we're going to have to see what we saw in the 50s and 60s. I mean, interest rates stayed bottom from the early 30s all the way really to the 60s.
Yeah, they did.
Right before they went up, and of course we know what happened in 62, 63. 1.5% inflation. The next minute, bang, and everyone's saying that's what's going to happen again. Now, there's lots of reasons why that might not happen now, because obviously a much more globalized world and all that kind of technology and Amazon and all Google and all this rubbish. But at the end of the day, we kind of know these things happen over and over again. So for me to sit here and say, after 400 or 500 years of pretty strong evidence that we're going to have a change at some stage, and most of that change will be forced on us politically, and I'm seeing it firsthand, right in front of my face right now, and we're seeing it throughout Europe, we're seeing it throughout the US. The emerging markets are under a certain degree of control right now, so it's not happening. But certainly around the US dollar, there's going to be a major change in my view, and that's going to change.
And the US dollar will appreciate.
Well, the way it actually ends is not from the US dollar going down, because everyone's going to be happy with the lower US dollar. What squeezes the system is when basically there's a lack of dollars in the system. And if you think about 2013, right, and how we solved the 13 crisis, or even how we solved the European crisis in 2011, it was all through dollar swaps. Because what they ended up happening is the Fed, and this is what the Senate are really upset about, is why did you provide hundreds of billions of dollars worth of money to the BNP Paribas and all this kind of stuff? Because actually it was the shortage of dollars which makes these crises much more difficult. So as the Fed had to provide loads and loads of dollar swaps to actually reflate the system in dollars.
And Steve, if there was one investment implication from your kind of dollar falls out of from the reserve currency to just a reserve currency, what would the investment implication be? Would you absolutely not be holding US bonds?
Yeah, I mean, look, clearly that is the implication. And clearly the implication is actually, if you look at some of the local emerging market space, if they've got the strong fundamentals and they still have the growth, well, there you're going to go, well, am I going to buy a 10-year bond or a 5-year bond today at negative rates, or I'm going to buy US rates? Yeah. Now, mind you, having said that, US rates have gone up a lot. We've nearly got 170 for the 2-year in the US. It's not a ridiculous, given where we were a couple of months ago even, it's not a ridiculous level. But you're kind of seeing what's the shift going to be. And the shift is clearly being, those people want to pay you for the return, the risk you're taking. You're basically being told now that the game on the developed markets is a game of, I suppose, capital appreciation before I get killed. So I'm earning no carry, but I'm going to buy this asset on the hope that I make a bit of capitalization, I get out before the rush for the exits, if there is a rush for the exits. So we do see all these dynamics going on. Where we do find that today's problem is around the structure of the bond market. How we've talked about this beforehand, how we've issued a lot of bonds against some really poor quality credit, et cetera, et cetera. And that's an issue where we can have a higher rates, not to do with politics or economics, but just the very nature of the market.
We'll come back to that, because I want to talk about how people have gone into more liquid stuff.
I think that's sort of, like, it's a very nice discussion to have, but is it practical in terms of the month-to-month, year-to-year investment decision?
Yeah, exactly.
That's a 10, 20, 30-year time frame. And so if...
But you come back to Steve's argument, you're not being paid any carry whatsoever to stay in the game. There's no reason to stay in this game. You know this car crash is coming. Why stay in the middle of the road picking those pennies?
Well, you don't.
Yeah, absolutely. Please, welcome questions.
Sorry, you suggested that every 100 years we switch reserve currencies.
Roughly. 120, 194.
Sorry.
And admittedly, this reserve currency history is about 100 years old, and it's mostly based on the petrodollar.
Yes.
But isn't it far more likely that we don't switch out of the U.S. as a reserve currency in a petrodollar, but rather switch into, I don't even know what this is called, but
SDR.
A basket of currencies.
Yeah.
But a basket of currencies, but not even necessarily a basket of currencies, just a world where there is no reserve currencies, where everybody's, like on any given transaction, you're taking a bet on the currency.
Yeah, absolutely. And just because we're being streamed, so I apologise. I do end up repeating the question just so everybody can hear. A very good question, which is, it's the Keynesian question actually. Keynes asked that question originally, which is why have a single reserve currency when you can have a basket, or even, in fact, no reserve currencies, but a basket of currencies. And why do we have to worry about the dollar falling out of the reserve currency? Sorry to repeat the question. I mean, that's a very valid point, isn't it?
I mean, what you're supposing there is effectively a fixed currency regime.
Yes, exactly.
And there's not a fixed currency regime anywhere in history, anywhere on the planet, which has been a success. It's the equivalent of buying a kettle.
Actually, I'm not suggesting a fixed currency regime or an SDR. I'm suggesting a world without a reserve currency where it changes day to day or year to year based on success.
Or transaction to transaction.
Yes.
Like you're saying,
But is that not what but SDR tries to do that, because the big problem with fixed exchange rates is it doesn't give a lot of flexibility when things go wrong in your country, which we've seen in Europe, right? And also the whole idea is what happened over the last 20 years in many ways was a fixed exchange rate, right? Let's not fool ourselves. The yuan to the dollar was the main trading and it was fixed, okay? And we built up massive imbalances in the system, okay? So those imbalances in the system had to get sorted out, and of course with 2008 now, a lot of people argued, even Greenspan half argued, that it was excess savings in Asia in the late 90s, you remember him saying that kept interest rates low, which Americans doing it. So I do believe that you need some sort of flexibility, and that's why a basket of assets where if the US terms of trade are X and China's are Y, you should have a natural rebalancing so that we don't go on 20 years of misallocation. So there's lots of different ways of doing it, But the SDR seems, by the way, and it's what Volcker recommended, by the way, to Nixon back in 1971 when they were getting off the Bretton Woods. His recommendation to the US was to go into an SDR. But then, of course, the Saudis came up and said, much better idea. Let's price it all in petrodollars. And it was a great deal for the Americans. But to us, I think, moving forward from here and the problems we've had and the amount of debt that we have in the system, we need to get a much more balanced thing. Now, again, you read Professor Razan from the Chicago Business School comes up with some good ideas in these, and lots of different ideas. We need something that has flexibility, because you're saying the euro has no flexibility, and I don't think in the medium term, or gold. Again, a lot of people talk about gold. I know that's not what you're suggesting, but it's.
I want to talk a bit about. Gosh, excellent! We're getting very interactive already. Go on.
One more question. We look at the West's ability to pay debt. We look at what they're paying for it now, and we look at the refinancing. If they started to just look at the UK for the time being, if we started to re-rate that debt at 5%, what chance would we have at selling it in 3 years' time? In my mind, it is completely undoable, which puts a cap on where we are now.
Sally, so your point?
I mean, if we are going to refinance the national debt at the moment at 5%, and assuming the world, or even 3.5%.
Yeah.
Okay.
But then you spend 4% of GDP on your interest bill.
Yes, exactly.
This is my point. Let's call it even 2%. 2.5%. The DMO, I'm not going to be able to refinance that at anything like a sensible level if we're on our own.
So
we are assuming worst case the whole world moves one. With
the
UK on its own, we're completely lost.
Well, we might get that with Jeremy, but I mean, just to again rephrase the argument, is that the idea, which actually I was sort of saying earlier, but the argument that we simply cannot afford the debt management office, the government can't afford.
We can't afford it. Let's be under no illusion here. The UK, the US, Japan.
Well, particularly
Italy,
Japan. I mean,
Italy,
look at it.
Spain, and you can list a whole bunch of other countries will all default on their debt.
At what stage? It's
They're
going
already
to happen at different levels.
No, but hang on a second. The Brits are defaulting left, right, and centre. Yeah. Printing money is default.
Absolutely.
Don't in any other way. But don't think
the actual pain will be felt at different times.
No, but pain is being felt by debasing your currency. That's being felt. Everyone said, well, there's no pain. You can buy 20% less of global goods because they debase the currency. That is real pain. And now you've got inflation of 4%. We saw the numbers today in RPI. So you're feeling it today.
So let's pick up on the inflation because I'm going to try and steer the debate also to some of the key issues I mentioned earlier. Inflation. Again, this is the great bogeyman that I hear all the time, and I know inflation, RPI is up, but we have particular circumstances in the UK. We have an open economy and we have Brexit. If we look beyond the UK, inflation rates are not that high. And in fact, I love reading Albert Edwards' work at SG, great perma bear, and he's always looking for evidence of inflation and never finds the bloody stuff. It's just not there because but it isn't there. Asset price inflation is there. Okay. Martin, I'm just asking you. I mean, do you see any evidence that inflation is in the system? It's asset price inflation. Okay, but classic.
But from a central bank perspective, they don't really care.
Yeah, they don't care about that. But CPI and RPI and all that kind of stuff. This doesn't. I mean, apart from the UK, it's just non-existent. Where's the pressure coming from?
Not from the demand side. If you look outside the US.
Yeah.
So inflation in the US has been suppressed in a transitory form by a number of different factors this year. Low airline prices, low telecommunications prices, low doctors' fees, and they're all very idiosyncratic in their respective markets. So we think that when you start to see these effects unwind, you're going to see some inflation.
What do you think it will look like? Do you think we're going to see rates? What do you think? US core rates up to inflation rates up to what? About 3%, 2%?
Yeah, 2.9, 3%.
So hang on.
Try 7.
Sorry.
Try 7.
Really? Why? Explain why.
Okay, so we got so much money in the system. Your problem with your inflation argument is your definition of inflation is wrong. Now I know that sounds very grandiose, but your definition of inflation is wrong. Inflation is just a price for things. And we printed so much money and we gave it to the industry who are the world leaders in the trade of second-hand goods. All of the equities, all of the bonds, all of the currencies we trade on a day-to-day basis are second-hand goods. And you don't see inflation in RPI or CPI numbers because they're first-hand goods. That's a new car, a new house, a new suit, a new haircut. But we are seeing massive amounts of inflation in the trade of second-hand goods. It's why your children can't buy a property. It's why equity prices are at all-time record lows. It's why we got $15 trillion of bonds on negative yields. We've got so much asset price inflation, and the mechanism for realising how it gets into the real world of RPI and CPI, there's these wonderful people in the economy, you've probably some of them in the audience, called entrepreneurs. And entrepreneurs arbitrage between the asset price markets and the real world. So at the moment, if you walk around pretty much any city in the whole of the UK, there's a fantastic property arbitrage taking place. The price for a 2-bedroom flat in Manchester retails at 300,000 sterling. I can build a 2-bedroom flat in Manchester for 150k. What do you know? There's, as a consequence, 50,000 2-bedroom flats being manufactured in Manchester right now. And as a result, you pull the inflation from the asset price markets into the real world. So there's now a shortage of bricks in the UK. There's a shortage of skilled labour in the UK. And eventually it will push up the cost of capital.
Yeah, but we're not seeing it in wage inflation.
Well,
Yet.
No, never. We haven't seen it. We haven't seen it for years.
Tell that to someone who's engaged in property. Tell that to someone who's working in the construction.
Yeah, but
tell that to someone who's building railway lines.
Yeah, but with all due respect,
and they've got 40, 50, 60% pay increases.
Okay, but no one's ever denied that there are localised pockets of wage inflation. But we have to measure nationwide inflation levels, and those are being depressed by low wages in the service economy.
Well, can I just make one point on this? Sorry, okay, because it's very important, again, the definition of inflation, and we're not going to spend the whole night doing it, but do you all, if people don't believe there's inflation here, do yourselves all a favour and go to shadowstats.com, okay? Because if you look at how inflation was calculated in the 1980s today, you're running it close to double digits. If you calculate inflation today, how they calculated, the BLS calculated in the 1990s, we're at 6%. Because they've chosen a basket of goods that suited their principles.
Oh, but hang on. Economists, to be fair, central bankers, and you were one of them, I did, they don't just pluck these numbers out of thin air. There are reasons why they change the basket.
But it is very interesting. What that tells you, though, is inflation is only a basket of certain goods and services that have been chosen by this group of people, okay? It doesn't mean that our inflation, anyone in our offices, any of your offices can sit there and go, what's the inflation in London over being for the last 10 years? And the central banks will tell you nothing. And I can tell you it's 9%, 8 or 9%, right? Now, it all comes down to your particular basket of goods. Now, it's very good for central bankers to say we don't have much inflation, but pushing all this money into the system has caused inflation to the system. It's just not because I go to my Bloomberg machine and I see an RPI or CPI very high. We are seeing it, and yes, we're not seeing it in wages because globalization and technology is having those impact on it, but in areas where there isn't an excess supply, and look at the price of an old Ferrari, not the price of an old this and all that. Anything that is limited supply, like bricks, when they get shortage, we're going through the roof, like that.
But just in the narrow sense, I was quite struck by the narrow definition of inflation, because I watch a lot of the kind of multi-asset managers quite carefully. And I was watching Peter Spiller at Capital Gearing, Jonathan Ruffer's crew as well. They've been making very heavy bets on inflation-linked bonds, very heavy bets on UK and US inflation-linked bonds. But they've been making good money, and actually we see. Well, they have. They actually have.
If bonds in the UK right now,
but they didn't. They bought them years ago.
At any point in the curve, you're guaranteed to destroy your purchasing power.
Yes, I think Peter Spiller was saying on UK it's minus 16%.
No, since November 2011. UK interest rates, real interest rates on the curve, went negative across the entire curve. By definition, when you buy
why are these smart managers buying them?
You might make numerical money. The numbers in your bank account might go up, but you're guaranteed to make a return lower than inflation.
But why are these managers buying them then?
Because they don't understand how they work. They buy because they think the inflation expectation is likely to rise, and yes, it will. But you still. If you buy a bond on a yield, negative yield of 1% over 10 years, inflation can be 1%, 10%, 1,000%. It doesn't matter what the number is, you'll still make 10% less in 10 years' time.
Okay, so what about
You're guaranteed to destroy your purchasing
power. Absolutely. I don't disagree with you on that one. But what about the great kind of disinflationary drumbeat? Yeah, again, you've heard this argument, you know this argument fairly well, which is technology. Globalization, and all the phenomena that goes around it. We can all work out we're all intelligent people. That basically is going to keep a lid on prices. I mean, Amazon is one enormous inflation killer. Yeah, let's be honest. Immigration across boundaries and workforces is one great wage inflation killer. That's why people voted. Part of the reason they voted for Brexit. A lot of reasons, but that's one of them. That's undoubtedly one of the reasons. There's lots of these pressures out there. This isn't going away. The disruption, James Anderson over at Scottish Mortgage and Bailey Gifford has been betting big on disruption. It's the big thing, and every one of the things you've mentioned, Martin, has been in terms of US inflation numbers has been affected by some of the technological and disruption forces. That they are really, and they're not going away. So where is this inflation in product prices? Okay. Accepting your argument on asset prices, none of us can argue with that. But on actual service and good price, where's it coming from? It's not there.
It's not there, but it's coming through in wages.
Is it?
In the US it is. Not on average in the UK.
Mm-hmm.
And the tighter that labour markets become, the more you get to that marginal worker which asks for more money. And that means that you need to be, as a business, you need to be like expanding your margins.
Or you just invest in a robot that does away with the work, which is exactly what the American companies are doing. Massive wave of expenditure on automation to do away with labour pressures.
Yeah, because of cost of capital versus cost of labour.
Yeah, fair point.
So let's think outside the box for 1 second on that very point. Okay?
Yeah.
And let's just think about your argument there about all these things that are driving it. Why are all these things driving it? And why do we have, because actually, ironically, the central bankers may have got it completely wrong, that actually QE created deflation, not inflation. Because what did QE do? Ultimately inflated massive excess supply of goods. So not only do we have now one company providing taxi services, we've got two. Not only one company that's going to give you a hotel, but we've got three. Right? So all of a sudden, what the world has done through QE, and actually if you look at the supply of oil, for example, it's nowadays it's more highly correlated to the high yield market than it is the price of
because of all those shale guys raising
So
capex.
we've been looking at that for a long time. So here's the crux. Look at what happens now, and the commodity market's always a good indicator. You take away a lot of money from those guys, and you tell them don't mine anymore for copper. You don't mine for this, and China, you calm down for a second, and you cut your supply. What's going to happen? Prices will probably go up. So ironically, quantitative tightening, if you like, could be more of a tool to create inflation than quantitative easing, because all quantitative easing did was create a massive excess supply.
Okay.
The Chinese, by the way, did 23 trillion in investments in the ability to produce steel, cement, etc., etc. So we can argue that actually, if they start taking money out of the system, in many ways, we'll go deflation in asset prices and inflation in goods prices again, because that change will happen.
Martin, I just want to bring you in at this point.
See those numbers in terms of the capex in the mining resources sector, but it's usually about a 12 to 24 month lag between the reduction in capex and a rise in prices, and we've seen commodity prices slump for the last 5 years. So it's going to take another 1 to 2 years before you see those supply side price pressures.
But the missing kind of Banquo's ghost here that is not in the room is China. Yeah, China ain't about to do monetary tightening. Yeah, and it sure as hell isn't at the moment. Am I wrong?
I think they know. I mean, the outgoing central banker wrote 2 significant letters in the last 3 weeks to say we've got a debt issue and we've actually used too much.
Oh, well, they have a debt. They have a bad debt issue.
Yes.
Yeah, they have a bad debt issue, which no one can possibly deny. They've had a bad debt issue for years. It's been rumbling around, but they've been opening up the spigots in terms of credit creation and the monetary supply for the last year and a half.
Yes, but now their problem is they can't provide. They were doing that through these wealth management products, which are creating their balance sheets to create the thing. That is now slowed down, and in fact, they're starting to wobble right now. And now they've gone on this big wave. Well, we need FDIs to come in to support even further credit creation, and the FDIs aren't coming. So the Chinese know that they have a massive issue, and they're looking at it right now. And if you look at it as say investment as a percentage of GDP, it makes Japan and the Irish property market look like a joke in terms of what they did. So they do know that they have an issue, and they are going to. And of course, look, it all comes down to political pressure and everything else. What goes on within China is difficult to monitor from that perspective. But they will try to slow down that creation, and they're going to try to rebalance their economy. I know people talk about that, and it's not straightforward. But at some stage, they cannot keep at the pace that they're going. And if you look at the M2, by the way, today in China, it's probably the lowest it's been for 20 years, 30 years. So they are pulling back. And just look at the M2. They're pulling back. There's no doubt about it.
Kevin, if you accept the reset argument, you're sort of arguing that it's a massive misallocation of resources in terms of risk allocation of capital, and then we have a reset. What does that mean for fixed income investors? What the hell would you do?
You're dead. I'm sorry, if you don't need to invest in fixed income, don't. I'm sorry, Steve.
Damn!
Sorry, I shouldn't have used a bad word. Excuse me.
But if you don't need to invest in fixed income, why on earth would you? There's no.
Where do you invest that money then?
You take. You're a young man. Okay.
Flattery will get you everywhere.
Invest in real assets.
He's looking for an investment.
So
Okay, but if you're investing for people that aren't young men, and you are a young man, where should I put that money?
Yeah.
we need to build an ark.
Okay,
Okay.
in absence of the art.
Okay, so I've come back into the industry to build an ark. It's the only reason I came back.
Let me know.
Not an actual physical arc, I might point out.
I will look like Noah. I will look stupid. I will look stupid for a couple of years.
Because you'll be so old?
With the beard, I'm not getting a beard.
I'm not quite
I
sure.
agree with what you're saying completely. I just don't know what to do with the rest of the
Yeah, it's a good question.
That's the issue.
That's our issue, yeah.
Yeah, that's I was going to come to what the hell do we do? I'm glad you raised that. So what do we do?
But I'm not completely convinced of that argument because, 2008 was a very specific time, and I know it's very easy for all of us who were in front of our screens in 2008, everything go back to 2008.
I turn them off.
Right, but well, my investors would have been a bit annoyed if I. So where's things say? I don't know, and I don't care anymore, lads. It's all over. It's all over. We've lost all your money.
I'm down the boozer. Chat to me down there.
exactly.
It wasn't that it was all over. It was just so distracting.
Yeah, but
You became embroiled in the minute
Yes,
by minute.
I know, but the point is, what happened in that scenario actually was that all of a sudden good quality assets became very, very cheap again.
Mm-hmm.
And the point is, it's how you manage volatility in that period. And that's where I think, and we're not going to go into this argument because we were told off limits, but this is the passive versus active thing. And I actually do think that, I remember a very interesting article in college reading Grossman and Stiglitz wrote an article in 1982 about this very, very conundrum between passive, and he sees it, this has been going on for hundreds of years again, where all of a sudden passive goes up in a bull market and then all of a sudden things become cheap again and active managers get paid for their extra risk. So I do think there's a different world, there's a dynamic change in the world. Emerging markets are still 50% of global growth. They have 5% of global government bond markets, right? So they have ways of paying you back the money. Yes, for a while you're going to lose money for bonds and treasuries for sure. But there is going to be dynamics, and your ability to manage that volatility, I think, is key, and having a flexible strategy through that, I think, is where you will be successful.
Yeah. And to be fair to you, I'm saying in the developed world, those countries I named before you, UK's, US, Japan's, all of these guys, they were all default. So just don't play that game.
So, but hang on a second,
You
going back.
play the game in a sense because when you've got yields this low, the moves that used to play out in bond markets are just being played out in the FX market.
Yeah.
So you can run your portfolio as an FX.
If you want a liability match, just hold your own currency.
Yeah, of course.
So
That's
actually,
like hedging.
so I just want to drill down to this. So what do people do? Yeah. So they don't invest in your scenario, Kevin. They don't invest in bonds. In your scenario, Steve, they look at emerging market bonds, for instance. And I'm sure we'll come to this in a minute. There are other sorts of strategies that you can do within the fixed income space, or maybe not in your argument. But equities, by your argument, don't sound very good because they're massively overvalued. They've been pumped, in your argument, massive asset price inflation. They've been pumped full of liquidity.
But you'll still get a real return. It won't be a very high one.
Okay.
But you'll still get a real return.
Okay. So
don't get me wrong. No one's going to improve their purchasing power. You'll make lots of numerical money over the next decade, but no one's going to improve their purchasing power over the next. So your equities might do 7% over the next decade.
But that again
But if inflation's 7%, you're no better off.
Yeah, but that goes again to your basket and what you're buying.
Yeah.
And what you're purchasing.
Yeah.
Sorry, that doesn't make sense though, because how can you have inflation running at such a high rate if no one can afford the products they
Yeah,
buy? So
that's interesting.
naturally deflationary.
No, where the inflation we're talking about potentially could come from, and I'm not making this particular argument, but the point is where you have the supply slows down. And that's where we're kind of worried about. If you pull the money back too quickly, dollar rallies, you will potentially have a situation where, as he mentions, you could have shortage of supply and all the rest.
Because zombie countries can't exist.
Yeah, exactly. And then people go out of business, and all of a sudden there's a shortage. And Weimar Republic, most of it was about shortage, mainly a shortage of actually being able to print the money fast enough. But there were still shortages which caused the inflation to happen. You've had hyperinflation in Zimbabwe and places like this. So you've got all this money floating around. You've a lot of goods available, and all all of a sudden you have a hyperinflation in Venezuela, etc., etc. So these kind of models do tend to end up in an inflationary world.
But just go back to your argument, Kevin. So you would be buying quality. You would be buying quality cash generating assets.
Anything where the cash flows from that asset adjust for inflation, that's a real asset and you should have in your portfolio.
So a business.
Yeah.
So, but that surely then is
property.
Sorry.
Prime property.
Really?
Because
but surely, but hang on a second. Hang on. You guys have just spent the entire time arguing that actually we've had an enormous pump of money into real assets. Yeah, London prices have gone up crazy, and you're still investing in prime assets.
But my starting real yield is positive, and that's such a prime property that when inflation comes, I can put my prices up.
Okay, but
so I can make a small real return. My fear is, and I will go into Noah mode here. We are going to drown out savers.
And the problem is, if you're not making a real return, you're making a 7% negative return, aren't you? And that is terrifying. You compound that over 5 years,
what you purchase.
real issue.
Yeah.
I think your capital risk is massive. That's the problem. Your capital risk is huge. If you're happy to live off the interest of the asset and not care what the asset is valued at, that's a fine scenario to be in.
And to answer the question a bit less trite, if you have to invest in fixed income products, buy bonds that you're happy with, hold them to maturity.
Yeah.
Good
old-fashioned idea.
The only place that you make a numerical return in bonds is things that you're happy to hold to maturity, you're comfortable that there's no default risk in there, and you know what your return is. So you capture the liquidity premium. When you buy a bond, you buy three sources of risk. You buy an interest rate risk, you buy a credit risk, and you buy a liquidity risk. The first one, that's a disaster waiting to happen. You might, with someone like Steve Skills, be able to find some credit ideas that make sense. The only place you can capture any return in fixed income right now is in liquidity.
So that's what I'm going to come to. So we've seen an awful lot of people move up the illiquidity curve, if you can move up a liquidity curve, but they've certainly moved up the risk curve, and we've seen a lot of money go into kind of high yield credit and all that kind of stuff, and even more illiquid direct lending, all that kind of stuff. Now the argument there is traditionally, oh God, that's terribly risky and that's really disastrous, and that will all go horribly wrong. It will blow up. But actually, the reality of it is, these are quite often the businesses you're talking about. These are real businesses. They're admittedly higher risk businesses. They're not Diageo, they're not Unilever, but their rate, as we both know, their interest rates are down there. But you are picking up 6-7% or 5-6 or 4-3 as I go down.
Most of which is liquidity.
Yeah, absolutely. And is it worth taking that liquidity premium at the moment? Do you think?
Provided you do it through the right vehicles, you've got to kind of you've got to own these bonds yourself. Don't do it through an open-ended fund, because then you've got a liquidity mismatch.
Interesting.
Yeah, but I think that there's another reason they're happening as well. And yes, there's a search for yield, but don't forget as well, a lot of these things were developed after the crisis in 2008 for a necessity, because the banks weren't lending, right?
Yeah.
So we're seeing firsthand how these businesses have developed. And I think it's very interesting because, of course, people needed credit. There was people out there who didn't want to put money in the bank and earning no yield, and all of a sudden the guy says, I want to borrow money, and says, well, hang on, why don't, instead of putting it in the bank, I'll give you the money, and direct lending and all these kind of things started to develop. So I think it might not end up an absolute disaster, because it is a part of the system now where we don't want the banks to get too over leveraged, and central banks want to control them more in terms of that. And the private sector is saying, well, I'm not going to be killed by putting my money on balance. I'm quite happy to lend to this business who lends to a school that want to develop this, or whatever kind of business they've seen. And I've seen some very interesting business to do it. So there is a changing nature. This is where London is fantastic, where just in front of our very eyes over the last 8 or 9 years, the developments from fintech, all these things that have been developed, and we are, as an industry, and particularly London here, when we all talk about Brexit, but the big positive for London is there's a lot of very bright people who push the envelope, and yes, they pushed the envelope the wrong way up to 2008. But since then, we've seen a lot of innovation in the industry. Yeah. And it's actually helped make our jobs in many ways easier, our asset allocators, because there's new types of products, not all good products, but some good products that I think gives more choice to investors.
Kevin, at the moment, you're not investing in fixed income at the moment. No, but if you were a fixed income manager again, I said you're very good at it, would you be putting your money in illiquid bonds and illiquid lending at the moment?
Yes, provides I had the right vehicle for it.
Yeah.
So if I had a closed-end vehicle, that's absolutely the strategy I'd be
following. Really?
Can I ask,
Interesting.
Because I agree with what you said, at the right price, illiquidity at the right price. And there's a lot of people here who run money, often using direct bonds and often using funds. We had a problem a couple of years ago where people were stacking into funds, open-ended funds, on the hope they might be able to invest directly at the right level. The result was the open-ended funds took all the money, had a pile of cash, and didn't do a lot with it. It made a lot of people feel happy for a day or two, but after 6 months they realised they'd actually done nothing with their money. What is the answer going forwards? In terms of, yes, we want to be in the correct bonds at the correct prices.
And the correct vehicle.
And correct vehicle, absolutely essential. On the other side of the coin, should we, I mean, where are we hoping to end up in these things? We're going to end up in, we might be buying 2, 3, 5 year dated bonds. Is this from an inflationary point of view, which is what we're here today to talk about, partly, and we're all very concerned about, are we going to find we've bought some clever bonds over 2 years and actually inflation has made us look like an enormous idiot over 5 years? What can we do to protect ourselves from that, and where should we go?
Kevin, you go for it first.
When inflation's coming.
Because you just said buy a 5 year bond, a 3 year bond, and you'll be all right.
Yeah, and I wouldn't go. I'd sooner hold a 5 year bond and have the option to reinvest at potentially the same or a higher interest rate in 5 years' time,
At a lower
than
price.
to go up and buy a 20, 30, 100 year bond. Where when the adjustment comes, that's when you'll be crucified.
Good advice.
And also you're saying as well, which I think, again, I'd sort of agree with, is the vehicle matters and the nature of the liquidity matters.
Yes.
And that's a huge issue, isn't it?
Because you come back to your point, a lot of money has flown into bond funds over the past decade, really. You know, I can remember going back to 2009, and I did it myself. I went out to my investor and said, there has never been a better time to invest in bonds.
And there wasn't.
And there wasn't. It was a phenomenal opportunity. We bought John Lewis bonds on 10% yields. We bought Westfield bonds on 12% yields. You know, it was never a better time to invest in corporate bonds. That was then in 2009. Now there's never been a worse time to invest in bonds. And so much money's gone into the sector. But what you got to remember is that intervening period, that 10-year period, when money comes out of this sector, you used to store your unwanted inventory on the bank's balance sheet. You would go back to your broker and you would put your unwanted inventory on the bank's balance sheet. Those balance sheets don't exist anymore. There is no warehouse for unwanted inventory. And so when this liquidity crisis comes, and it will come, you will feel the impact of it almost instantly.
What about, just going back to your, just to hear all your views on this, a lot of investors, I think it's been mentioned in the room, do buy individual bonds and hold them through to maturity. So one of the reasons we've had because a lot of people here are retail orientated, and there've been the retail bonds market, which actually hasn't had much product, but it has been out there and it has been doing stuff, and people have been snapping up that stuff. And you know, they've been getting 4% yields, 5% yields at a push. And actually, by and large, they are largely holding to maturity. It's buy and hold investing because they're happy to. 6-year product, they'll buy it and they'll get, it's not a great rate, but they'll get 4%. It is slightly riskier than other stuff. That's not a stupid strategy, do you think?
It's not a stupid thing, provided you diversify that portfolio.
Yeah.
Because you will, if anyone's investing in retail bonds, you only got to have been hit with an EROS or an Enquest.
Yeah, or Premier Oil.
Or a Premier Oil, and your 4 or 5% carry on the rest of your portfolio is obliterated by 50%.
Well, it wasn't though when you bought it at 50 quid. Okay, so you might look at geographical diversification. Yeah.
Well, yes, but I think first let's come back to kind of what we kicked off with. All very good stories, but I mean fundamentally investing is about, in many ways, the price you pay. Okay, and it comes to timing. And my only concern right now is by going into anything illiquid right now, is the sense that rightly or wrongly, they might try to kick the can, but they're certainly going to try to pull back this money, this ridiculous QE that we've seen right now. And the US has started, the Europeans are doing it slowly, but I think politically they're going to be forced their hands further and further.
By the way, I'm going to come back to the real idea that QE is ridiculous, because I'm going to finish with the argument it isn't.
But my point right now is the most valuable thing to me right now, the end of the biggest asset bubble or asset rally we've seen in history, is to be short and to be liquid and to own things that which you can actually find. Because the way, if you want to make money for the next 10 years, the easy way to do is wait for the next blow up. And like we've seen it once after another, bang. So when did you make huge money? By buying in 09. You're not going to make money when the VIX is 8, you're going to buy money when the VIX is 50. So the way we look at risk is we only buy assets, we only take on risk when risk is, or volatility as they call it, is that extended, because then you know you're going to get paid for things. Anyone going out and buying new assets when the VIX is 8, and that's just a general, obviously just a general indicator, but you know that there's a problem, no one's paying you for risk. So the point is, it really comes down to timing. The markets actually give you the buy and sell orders. Just the markets always get it wrong. The markets always buy when the VIX is 8. And the big issue we have today, and we're not going to discuss it now, but this whole thing about how the volatility is going lower, which is allowing these risk models for people to take on more risk, which then allows the volatility to get even lower, which becomes a self-fulfilling thing. And this is what I alluded to a bit earlier on, where this whole thing, this is a powder cake, that this could go up very quickly, because then all of a sudden the VIX goes to 20, and you've got $2 trillion of short volatility trades that are going to blow up in your face very, very quickly. So
CPI all over again.
absolutely. So we've got this issue. So my kind of feeling now is the best way to manage the next couple of years through these economic experiments that central banks are doing, and they are pure experiments, is someone's going to get it wrong somewhere, which is going to give me a great opportunity to buy something. And I wouldn't right now put my money into something that's illiquid, which I know potentially the capital value of it could go down by 40%. And that's where I'm kind of going. I'd actually rather stick even a 2-year treasury at 170.
But that's my point. You buy illiquid positions and forget about them.
Oh yeah, no, that's absolutely true.
Don't even check the price.
I'm just going to ask you, Martin, ETS Securities is big in gold, and gold is one of the great indicators of the concerns that Steve's talking about. When people basically either hold cash, or they quite often hold gold, or they hold both, for different reasons. Gold is not cash. Gold is a different thing entirely. Yeah. Are you seeing, from a firm perspective, obviously the price of gold sort of moves around. It does what it does. But the gold hasn't broken out in price range. Gold stayed in a range. And by and large, have you seen people getting out of gold, because you do physical gold, don't you? Yeah. Have they been selling out? Tell us what's been going, because gold is a canary in the gold mine.
They've been consistently buying. There was a big period at the start of this year, 2017, where there was huge inflows in sort of end of January to mid-March. Then there was a bit of a lull because the equity markets were rallying strongly, and there was no sort of calls that the equity valuations are getting too stretched, because you're seeing the earnings start to back it up. And now we've seen another period where we've seen very strong inflows into gold.
And I think that's one of the most interesting stories at the moment.
It's twofold reason. As a non-yielding asset, gold's doing very well compared to a lot of bonds, and will continue to when inflation comes through next year. When you're in a depressed and negative real interest rate environment, gold performs well. And you've got the defensive investors, and we've got to think about why people invest in equities, why they invest in different sectors, and why they invest in bonds. And it's a less volatile, so more defensive area of the market, and gold is that.
This was the asset that was trading at $2,000 7 years ago.
Yeah, but it goes in cycles, like any investment.
I don't want my safe asset to drop by 40%.
Well, actually, the irony is, if you think of it, because we're all sitting here and we're all thinking US gold $2,000, right? You just said to me what it was in USD. If you were a sterling guy, do you know what the hell gold is now? I mean, if I'm a UK guy,
exactly,
I go, well, hey, that's the best. Again, I do a lot of work in India, right? And what do the Indians always do? And they've been doing it for thousands of years. When they go through the inflation spike, what do? They go and buy as much gold.
Listen,
and it is an amazing store of wealth.
About buy and hold.
Yes.
Because if you bought it when the UK government was selling it back in the
250,
250, 300.
I'll take some of that straight.
But the reason I wanted to mention this, and I will come to the question next, is just that I think it's very interesting that when talking to these guys is that I'm a massive gold cynic, possibly like you, okay, and I'm Warren Buffett school, which I don't understand it.
It's not gold specifically I'm a cynic of. You look at commodities, if you want to get the equilibrium price of any commodity whatsoever, it's the marginal cost of
exactly.
production.
Slightly different.
And in the gold market, it's $800.
But the reason I just wanted to pick that, I don't disagree with you, but the reason I picked this argument though is that gold is holding a trading range of about 1.1 to about 1,350, somewhere like that range, yeah. And I sort of expected, being very kind of, I don't believe in gold at all. I expected there to be massive flows out of it. You know, people go, it's boring, it's not going anywhere. But the most interesting talking to these guys is significant inflows into gold, and people are sticking with gold through that trading range. So I think quite interesting against what you and I think. But it does show that there is that money out there that's floating around.
But no one's ever saying sell all your equity, sell all your
Yeah.
bonds, and just buy gold.
Yeah.
There's great TV shows showing those people.
Yeah.
And they're very entertaining for other reasons. But you're sort of holding 2% potentially of your portfolio as
Yeah.
well. And when that crisis comes, whether it's next year, and it depends what crisis it is, if equities dump 20% in December, then you're going to be seeing big moves in gold.
I just want to ask a question. You gentlemen asked a question over there.
Just on the point of obviously liquidity, etc. I mean, obviously, 2009, central banks sort of opened Pandora's box of QE. Do you think it's possible that we could see today, given the current environment, given we now have, QE has actually been in place for such a long time, that central banks essentially have this as a policy tool, it might be in the back pocket somewhere. Do you think it's possible that we could actually see a liquidity event on the scale of 2008 ever again, given central banks can, like that, if they need to, oh guys, don't worry about it, we're printing.
Yeah, just in case the people at home, or wherever it is they're watching, could we ever have this liquidity event? Because effectively central banks could just turn on the liquidity tap and say, we're not going to have 2008 and 9 again. It's not going to happen.
We can see the start of one, but you're right. Beyond the no illusion, zero interest rates and QE is now standard central bank policy.
Unless the big unless is, people predict or look at it and say they were the cause of all evil and we're going to go the other way. And that's the issue, is when we have another crisis, people might go, and the politicians in particular who are looking for a patsy and a scapegoat will go, we're in this mess now because those guys printed all that money. Now, I'm not saying for 1 second they will, because that's a brave call, even for Corbyn to make, that they'll go that route. But again...
Wouldn't Corbyn like his own printing press?
Of course he would, that's what I'm saying.
Which brings me nicely to my last question, and then we are just going to open it to the floor generally, which is, I sometimes feel as though I'm in the cabal of kind of Austrian economists here, who think it's all going to end horribly wrong, give monetary debasement, it's all terrible, it's setting up these kind of things. I'm being unfair, I'm mischaracterising the argument. But there is a whole different school out there called Modern Monetary Theory, MMT. For those of you, look it up on Wikipedia, it's great. And even Paul Krugman has busily slagged it off, which tells you there's something interesting there. And their argument is quite completely the opposite to what you're saying, is that you ain't seen anything yet, yeah? That QE actually is quite mild at the moment. We could carry on printing money, particularly in the developed world, the US and the UK, because they effectively control their foreign currency, they can control what they do. Central governments can effectively, in effect, nationalise banks and use them as credit creation processes. And in fact, we can have a massive increase in monetary creation. We could do things like helicopter money, which has already sort of been tried in Japan and could be tried much more successfully. There is an alternative, a very respectable economists, yeah, I don't agree with them, but very respectable economists who argue that actually when the next crisis comes, we are going to see helicopter money, negative interest rates much more consistently, and a whole barrage of monetary interventions that are going to make what we've seen at the moment look like nothing. And if that is the case, and I would argue that the political momentum of that argument is much stronger than this mysterious political momentum that's going to put interest rates up. And how's that going to work? Yeah, the actual political momentum is going to be the opposite way, and you're going to see the monetary spigots open. I
think that it came out in Bloomberg today that the top 1% own 50% of world assets. You do that, the top 1% will probably own 75 or 80% of global assets. And again, it's amazing. You look at problems. You look at the. Sorry?
You invited Piketty.
Yeah.
No, but like
but hang on. The argument.
French Revolution. Look at the French Revolution. Look at the Russian Revolution.
No, but the
look
argument.
At the Gini coefficients, right? But it's not possible politically to do that.
But to be fair, I don't believe this, but I'm making the argument. Yeah. But this is that actually you do have helicopter money, and you effectively have a kind of mandated allowance for everybody in the economy. You repay their student loans. You give them a kind of universal basic income. I'm not making that argument.
No one's better off. You've got numerically more money, but no one's better off.
Circulating the economy.
Yes, but then again, what you do win, your debt to GDP goes down. Potentially your debt to GDP goes down because you actually now really have inflation. Because the problem is they're trying to push inflation down. I mean, arguing about inflation. Still, it's an open argument. But the point is, with monetary policy, you're trying to put it into the system, and it stops with the bankers in the top 1%. What even Larry Summers was saying when he was nearly elected head of the Federal Reserve by Obama, he was his number one choice. Because what Larry Summers said, and rightly or wrongly, was this isn't working, but you should do this, which is to give the $800 to everyone every month, and all of a sudden, can you pay your mortgage? Absolutely. Can you do this? Can you do that? Absolutely. Okay, and that is but by all accounts, that's a reset button. So maybe that is the next experiment. But I suppose our view is that this is guessing, and we don't know who's going to. We don't even know who's going to be in the Fed next week, right? Everyone's resigned, so we don't even know. We talked about discussing the Fed here. We don't know who's in the Fed, right? There's one guy, and everyone else is scarpered. So the issue is we really can't tell what the policy is going to be, and all these things like MMT and everything else, go bring back the gold standard, are possibilities. From investors' perspective, which is getting back to kind of what we do every day, is actually we need to have a system or an investment process that will manage those changes, because we can't predict.
So if I'm going to ask you, just to finish and we don't open some questions, what are the 2 or 3 things a lot of people have got to have some allocation to income, yeah? Practically, a lot of older investors need income, for instance. Income is a requirement, yeah? And some people actually have to have an actual allocation to fixed income. I mean, your pension funds, you're mandated to, the institutional pension funds. What are the 2 or 3 things they should be looking at if you have to allocate to income and fixed income at the moment, Steve? What would you be doing? Summarise it.
Quite frankly, stay away from passive. It's a nightmare waiting to happen, because you're buying 30-year corporate bonds with 2% coupons. So 1% increase, you lose 50% of your assets is madness. So passive investing has to be a no. Go active, but basically go active, but be prepared to sit on the sidelines for 12 or 18 months, because the opportunities in 12 or 18 months, as they try to change their policies, could be phenomenal. And for me now, we've got to the end of the first leg of it, if people could argue. They're going to try to unwind it. They might go back into it, but the only reason they're going to go back into it is because the unwinding failed. The winding failed means that yields are much higher. And my long-term prediction, and forget about 1948, is if I could get 6% yield on investment-grade bonds for 3 years, I got 9% in 2008. I think I'm going to get 6% again. I would jump all over that, and I'm willing to earn 2 or 3% for the next 18 months for that opportunity to buy a 3-year bond at 6%.
So are you sitting on the sidelines at the moment?
Pretty much.
Oh, okay. Kevin, 2 or 3 things that you'd be doing at the moment.
One question
Oh, sorry. Yeah.
How long have you been sat on the sidelines?
Yeah.
Since probably March or April.
Interesting. Kevin, what are the 2 or 3 things you do?
Remember that your greatest ally as an investor is time, and don't buy fixed income.
Let's sit on the sidelines again.
Yeah.
but you're not being punished to sit on the sidelines.
You'd be charged for leaving cash on the person. Would you invest in
Which is the equivalent of buying $15 trillion worth of bonds on negative yields. You're renting space in a central bank bond.
Okay, we're going to come to questions. So I will.
Individual, should I borrow money up to the hill and invest in property and rent it out?
Yes.
Ooh.
As my best inflation hedge.
Mm-hmm.
Indent myself absolutely up here.
And you should have done it 10 years ago.
Yeah.
But the trade's still.
Really? Okay, I'll come back to that in a second. I'm definitely going to challenge you with questions later on.
Property down the Thames, and it's all coming right on the market, right at the top, right at the wrong time.
Martin, what were your 2 or 3 things you'd be looking at the moment?
Regional diversification. So look at emerging markets, and because emerging markets are giving better than US high yield investment grade, and with lower volatility than the high yield space. And think about your currency translation, because you can buy local or hard. Probably there's going to be more of a move towards hard, because we think that the dollar's going up. So if you've got to stay in the
Dollar's going up.
Yep. So if you've got to stay in the developed market space, look to the US, because as we said, there's, in terms of the lower yield, you can get some extra currency when the dollar goes up compared to sterling euro. Okay,
so any questions? I'm sure there must be some. So Simon, I'll start with you. So so what's your question then? So Kevin, we should just basically just stick it all in buy to let, eh?
Everything I've heard suggests to me that I want to be the borrower. I'm paying nothing for it.
Yeah, we are.
And then I need to find something to invest it in that's going to go up faster than inflation, or at least at the rate of inflation. And at the moment in the UK, it still would be property. I'd go to Manchester then.
The unspoken policy of governments and central banks right now and they declared this on the 10th of March 2009, is there a war on savers?
Yeah.
And so if we look at this in World War type, World War One type 100 years roughly since the end of World War One, look at this from the trench warfare. You're in the wrong trench as a saver. Decide which front you want to fight on. Get yourself in the right trench, because you're going up against central banks. Your World War One, these guys have got nuclear bombs. They have unlimited firepower.
So we got to get on their side.
So get on their side. Yeah.
Yes, but I think it's fair to say, though, that that's been the case since 2009. And the point is it hasn't worked. And they know it hasn't worked. And that's why they're still doing it. So they might change tact, and that'll blow your trench up. So the issue is, our view would be they're going to try the other tact. And actually, we looked at the correlation between new business growth in the US and savings rate. Most people create businesses through savings, right? By killing savings rate, you're actually killing entrepreneurialism, you're killing real growth. And since 1972, only...
Hang on. Can I just check? So low interest rates, you're killing entrepreneurialism.
Because what's happening...
Well, I don't see any evidence of that out there.
Hold on a second. No. What I'm saying is, if you look at, so by the way, from 2014 on, is the first time in US history more businesses closed than started, okay? You look at how US grows. And by the way, if you look at...
But that might be to do with secular disruption.
Okay. If you look at it even before that, the correlation between savings rates and new business is very, very high. And that's been going down for 15, 20 years now, okay? And the point is now there's lots of reasons for that. Tax laws and big corporations are advising the government to have taxes like this and laws like that to make it impossible for new business to come.
Yeah,
I don't disagree with that.
Yeah.
But there is certainly a movement in my mind that says where we're looking at low productivity and the government has got lots of emphasis on they have to solve problems for everyone else's. We need people to solve things for their own. The US Fed did their own analysis, by the way, the San Francisco Fed, where they looked at the cost of zero interest rates. And they even said themselves that actually it's barely positive. And actually, if you look at the marginal propensity to consume of savers versus borrowers who get lower interest rates, it's actually negative. So if you go to zero interest rates, you're losing billions of dollars in savings that people would have spent that money. So what's happened is, so there's a cost-benefit analysis that they've even run themselves. And the US Fed have been talking about this and writing about this since 2012, how stupid these policies are, and they actually don't work. And guess what? They didn't work. They didn't work for Japan, they're not working for us now. So I wouldn't be convinced they're not going to try something different. Okay, and politically, someone's got to stand up and say change. Because if you go, by the way, and stand up in an election now and say, by the way, I'm doing exactly what the last guy did. Do you know how far you're going to get? Absolutely nowhere.
Can I cordially suggest if you stand up now as Steve and say I'm going to put interest rates up to 5%, you'll be destroyed.
I'm not even slightly talking about putting up interest rates in any sort of meaningful way. What I am saying is we don't necessarily need to see massive amounts of money printing and having trillions of dollars on banks' balance sheets. Okay, making asset prices go through the roof. Okay, what we are actually looking at is alternatives to that, and actually saying let's do quantitative easing. Let the natural rate of interest rates go up. Yes, some businesses will go bust, but actually, as I said before, it might actually stimulate inflation more. It might actually make us more productive. And this labour versus capital argument, which is capital is so much cheaper than labour, might get rebalanced. It might help your economy as well. So there's lots of positive. I'm not saying, by the way, it's a free lunch. There's no free lunch in economics, but we've done something for a long time that fundamentally doesn't work, and we've got serious social issues because of this. Youth unemployment, the ability of people who are only 15 years younger than me not being able to buy a house, starting families later. Look in the US, the number of people living at home with their parents has doubled since the year 2000. Okay, so there's real social problems that are being built because of this. In aggregate, the Wall Street guys couldn't care less. On aggregate, everything, we're richer than we've ever been. No, mate. You're richer than everyone else's. Nobody else's. Wage growth hasn't really grown since the 70s. So something needs to fundamentally change now. I'm not saying they will, but I'm sitting here and saying we're going to predict what happens to 2049 or whatever it was, and saying no one's going to try something any different. It'd be insane because we can't keep doing what we're doing.
That's what's happening in the US. We're getting to the part of the cycle where interest rates will be rising.
Yes.
Because we're starting to see inflation come through.
Actually, can I just say, can I just ask this gentleman first, and then you follow on afterwards? Sorry.
Just answer a few questions. First of all, what do you make of the flattening of the US 210s curve? That's the first one. The second one is, what do you make about emerging market PPIs, which are at a 5-year high? And the third one is, what do you make of, if this is overload, what do you make of the very subtle shift in what central banks are talking about, where they seem to be shifting from inflation targeting towards inflation plus asset price targeting?
So, and do you want to ask your question, and we'll bag them all up together, sorry.
I mean, wise men forecast bear markets. We all know there is some inequalities in the system now. We've got some massive artificial positions in the system, as you've all been saying. We're here to understand when they're going to end, not the fact that the cycle is going to move on. What can you give us to guide us? When is the cycle going to end?
Yeah, good question. When? Yeah. When and how? Okay, let's do the technical questions first, and then we'll also the big $64 trillion question.
210s.
Okay, 210. I guess what you're asking there is the bond market's starting to predict slow down the economy.
There's something going on.
Okay, so I would extend that further, and it's a bond market paradox. If the bond market was actually pricing risk, the bond market's currently telling you we won't just go through a slowdown in the economy. The bond market's priced in a 30 to 50 year depression. That's what, when real yields are negative, that's what the bond market's telling you. So we've got this situation where the bond market is telling you that we're going through a 30 to 50 year depression, and yet government bond yields have never been lower. And I struggle with that because if we're going through a 30 to 50 year actual depression, these governments will default. And not in the sense I meant it. When I was talking about default earlier, I was talking about currency devaluations and creation of inflation. If we go through a 30 to 50 year depression, I'm talking hard defaults, where they literally just cannot pay that money back. And so you've got this bond market paradox of the bond market's priced in long-term secular decline in economic growth to the point of no growth forever. And yet these people will still give governments money on an almost free basis. So 210s is a part of that story. The bond market's pricing in negative news, but the bond market's priced in really negative news for a long period of time. And the only way you can rationalise this is...
I was about to say.
The only way you can rationalise it is the bond market's being manipulated.
Yeah, because there's only one buyer, and there's
But break it down, okay? Break it down into individual components, right? The 2-year at 170, right, is not a bad guess on where the Fed might get to over the next 2 years. The 10-year, of course, is at its all-time highs in terms of its spread over bunds, right? So you're looking at treasuries and saying, right, everything is, give or take, right? So you're going to either buy bunds, you're going to buy JGBs, you're going to buy gilts, you're going to buy treasuries. Actually, the cheapest out there is the 10-year in treasury. So while I'm not discounting the fact that historically we've all looked at the flattening of the yield curve as an indicator, it's also being highly manipulated by, as you were just alluding to, central banks. The ECB are buying ridiculous amounts of things. So bunds are whatever 40 basis points. US Treasuries now in the 10-year space are a couple hundred basis points. And you're kind of going, actually, historically, if I'm looking at that going, it's never been cheaper. So it's very hard for the US Treasuries to actually sell off as long as bunds are kept down there artificially. So I don't know, and I actually don't know the answer to that. Normally I'd say, it means the things are going to go down. But because of the impact of central banks, this could be a technicality. That the inflation that you're saying coming, maybe more guys are looking at it, and they're seeing in the 2 years certainly pricing it in, but then 5 and 10s aren't. But that could be a function of...
Just your other two quick questions, and then we will come back to the big questions.
The second question was, have you noticed the very significant pickup in emerging market PPIs, which are now pretty much a 5-year high in an aggregate sense?
We've seen it come through from China. China basically drove inflation down to the low point in 2015. And remember, everyone was talking about deflation. Stanley Fischer was talking about negative interest rates in the first couple of quarters of 2016. Remember, the banks were going blowing up because there's going to be flat negative yield curves. And all of a sudden, we were talking about hyperinflation by the end of Trump, right? The madness. We'd already seen the bottoming out of that story by mid-15, right? That's why everyone was wrong, and that's why everyone should have bought banks in the early part of 2016, because the yield curve was going to steep, and there was no doubt about that. We could see it coming from the emerging markets. And actually, we imported a lot of deflation from the emerging markets for that period of time. Hence, that was where we were feeling. Now we're seeing the complete opposite. We're actually seeing a situation where we're going to be importing inflation from the emerging markets, which again is the marginal measure of growth to us. The US and Europe, they're doing fine at the moment, but we're still relying for the big bang in terms of growth from the emerging markets.
I'll just say that. And your third question?
What do you think of the subtle shift in central bank language, where we've traditionally, the last number of years we've had inflation targets,
Good question.
Little by little, it seems to me that central banks have kind of acknowledged that they can't really, that inflation targeting as a framework isn't working. And it seems to be now it's inflation targeting plus asset price control. Kind of. I'm just interested to hear what you think.
Kevin?
The analogy is Venezuela.
Sorry?
The analogy is Venezuela. The Venezuelan government got rid of the constitution, Hugo Chavez and then Nicolas Maduro, led by presidential decree, which is we print all these Bolivia we've created all these unintended consequences, and as a result, we now to, instead of addressing the core issue, which was we give petrol away for free, instead of coming back and fixing the price of that commodity, they went off and passed presidential decrees, which was the ban on the trade of second-hand cars. They mandated the price of Barbies, a whole bunch of stuff. It's the equivalent. So the Bank of England's MPC...
It's a distant equivalent.
No, it's absolutely equivalent. You've got the MPC, which has tried to control inflation using their monetary policy tools, and they've created a whole bunch of unintended consequences, and so they invented the FPC. They invented the FPC, and the FPC's already passed 2 sets of macroprudential policy. It's exactly the same thing. Instead of going back to the root cause, which is interest rates are simply too low, and it's led to asset price anomalies, what they're trying to do is they're now trying to regulate the asset price anomalies, and eventually they will upset, I almost used the wrong expression there, they will upset an ever-increasing greater scintilla of the UK population until eventually you upset so many people that they lobby their governments and they say, these guys are ruining my life. And that's the trigger to answer the question.
I was about to say, come back to that.
We started, to answer your question.
When's the hard reset coming?
That's the trigger when the central bank are not setting interest rates anymore at all. The public, through democratic means, have got interest rates back into the House of Parliament. The Bank of England probably loses its independence within the next 10 years.
So when do you think the hard reset's coming, to use your argument?
It's not a hard reset, it's actually a slow reset.
Okay.
The slow reset is people will sit in savings, and because numerically the value of their savings increases by 1 or 2% every year, they sit there and accept it, despite the fact that if inflation's running at 5 or 6%, you're losing money. Again, let's go back to that 10th of March 2009. You left your money in a UK bank account since March 2009. The value of your savings has gone up. It's gone up by 3.5%. Inflation since March 2009 in the UK now runs at over 35%. You've lost a third of your purchasing power, and everyone sat there and simply accepted it.
But these asset price anomalies have been around for donkey years. It's not just the invention of QE that's exacerbated. Like 2009, 2008, 2007, 2008 is a perfect example. No QE, but real asset prices got through.
They all had the same root cause, which is no, and it was too much money. So in the period 2000-2007, M4 in the UK grew by 11% year on year. There was simply too much money in the system. We talk about inflation, deflation, and that's your model of how the economy works. It's air going in and out of a bubble, in and out of a balloon. And all the conversation we've had this evening about wage growth and consumers and RPI and CPI, that's all noise within the bubble. What you ought to be paying attention to is at what pace is air going into the bubble and at what pace is air coming out of the bubble. And we'll go through QT.
But households are in better shape than they have been for years in the UK.
Exactly. So we'll go through a period where air is being put into the balloon by the central banks, but they only did that because the private sector was unable to do it. But have a look at all of the UK banks and all the US banks at the moment. They've now gone from repairing their balance sheets to expanding their balance sheets. And when a bank creates any money whatsoever, that creates money, we're pumping air back into that balloon.
And that's my idea of a well-functioning system. When the private sector has had a recession or problems, then you need the public sector to step in and support demand until the private sector is back on its feet.
Which is exactly what they've done, but what they
and
did
now
is...
that the economy's gaining momentum, that's when they're starting to take out the air.
The air was going in way too fast. Yeah. And they persisted by putting that air in at a pace of 10-11% year on year.
And I think you've got the story exactly right, because we haven't talked about bubble, we've talked about a balloon. And I think that's what the central banks realise from the taper tension, that they want the bond market to be a balloon rather than a bubble, so they can take out the air in a gradual and measured fashion, as we've seen from loads of central bankers. And I think that's the way it's going to play out.
But in the meantime, like I say, if you're a saver in the UK, you've lost a third of your purchasing power.
Any other questions? So there's two questions. I'll take both of them. So gentleman first, and then you second.
Obviously, I think it's pretty clear that central banks are being blamed for the asset bubbles setting up in regular asset classes. Is that why millennials are buying cryptocurrencies? And is it a legitimate asset class
I knew crypto was going to come up today.
I thought we touched it.
I've got 2 questions. One is, we talked about the differentials between 10-year bonds and treasuries. How are you trading that? And the second one is, I think we've mentioned most asset classes. We haven't talked about convertibles. Is that a strategy that we should perhaps
And the hybrids and all that kind of stuff. Okay. You start. Yeah, you go for the crypto.
You're the central banker.
I think it's a lack of faith in fiat currencies and a distrust of government policy not being able to do what it's there for. Is it a good idea? No. So I think, you've got something, and we've just done quite a bit of work on it in terms of marginal cost that we were talking about before. When you look at the power rate and the hash rates and how much it costs to mine, did this for Bitcoin, it's at about just under sort of $2,000. So it is a big bubble. The other issue is it's almost a reversion to the gold standard. Even if you've got widespread acceptance of Bitcoin and it takes over the pound as the dominant currency in the country, you've got a maximum money supply, a finite money supply, and then you're just stuck with a deflation problem when that hits, because you can't have economic growth.
That's just one type of currency. Bitcoin.
Yeah.
Crypto is like multiple. Right?
Yeah, about say Ethereum and all the other ones.
If you talk about UK trade and the size of the economy versus the size of AUM, when all of the cryptocurrencies max out, it's minuscule. So I think you're still looking at a deflationary
I'm guessing you two probably don't have a lot of faith in cryptocurrencies.
Blockchain is fantastic, but Bitcoin is not an investment.
Okay. All right.
It's
Great.
the modern day tulip mania.
Okay. I thought you might think that. So there are questions from over there.
Certainly, I wouldn't. I mean, there's a lot of risk around the European bond markets, given they're so highly leveraged to what the ECB policies are. So, I mean, Draghi's gone in 19, which is not too far away, and the likelihood is that there's going to be a German taking over now and be well vetted. But if the far right get even more popular with Germany, they're going to start blaming people that you normally blame central bankers, etc., etc. So, from that perspective, and given where German growth was today, and we saw where bonds are trading, clearly, treasuries right now look an awful lot on a relative basis, and I use the word relative, just in case anyone jumps all over me, looks incredibly more attractive because, again, they're further down the line of unwinding this situation, which means potentially, we're getting closer to a fundamental value of these bonds. I mean, the problem with the European bond market is there's nothing fundamental. I mean, Ireland is the second most indebted country per head of population on the planet.
Really?
Yeah, after Japan, and we issue 5-year bonds at negative rates. Okay, so we have no way of paying back the debt that we have outstanding. I think it works out for every private sector worker on higher tax rates, because don't forget, they're the only people who net contribute to the economy. It works out about 250,000 each. For the next level of debt. So there's no way to actually pay this debt back. So, but that's what the case, as we said earlier, for most the US families, an average debt of the US economy is about $1 million per family in the US right now, including the unfunded liability. So, none of this is ever going to get paid back. But yes, right now, the simple answer is treasuries look a hell of a lot. Not only do they look better value, they're also looking, let's say, for investor from a fundamental perspective, where they are in their cycle.
I've got time for one or two more questions, and then we must finish because it is nearly 7:45. So, Betty.
Just quickly, you guys mentioned that you thought that QE could come again, and they could do it negative rates, and all of this could happen in the next crisis. But most of sort of two-sided question. Most central bankers, especially Yellen, have said that the toolkit's empty. They've been pretty clear. When you're coming from this low a base, it's hard to go lower. And do you really think that pension funds will continue to buy negative yield? Like, how can you continue to force people to buy negative yield?
You shorten that accountancy period and employ actuaries.
But that's a very serious question. Because actually, there's a lot of, again, we use the word well thought of economists like Rogoff, right, who goes, we should go to 5% interest rates. Well, go back to January and February of 2016 and tell you what the banks think of that, and tell you about what the Japanese banks who think of those low negative interest rates. Negative interest rates do not work. your economy self-implodes. As you mentioned, the pension fund industry, the liabilities we're going to have. So hang on, $1 billion liability in 10 years' time is $1.5 billion today. You know, and it's only going to get bigger, negative interest rates. It's absolutely insane. It doesn't work. And there's loads and loads of well thought of, you know, MIT, Harvard, Princeton, let's mention Princeton there because they produce plenty of these guys. Guys who say we can go to negative interest rates. It is fundamentally flawed. Now I know Draghi has gone out recently and said, oh yes, the negative rates have worked for us and all the rest. Well actually, if you look at kind of some of the numbers, it hasn't. So I agree with you totally. I mean, maybe, you know, Stanley Fischer, who was the deputy head beside Janet, was telling the Europeans and the Japanese in January of 16 in Davos, you need more negative rates, right? Now, he's gone now, thankfully. But I am hopeful, again, back to my thesis, that they're going to change the toolkit and change the way forward because they know all these policies have failed. And I'm desperately hoping that they realise the next time they have a problem, going to negative rates is only going to make the problem even bigger. So there's only hope, but again, we don't have a clue who's going to be in the Fed over the next 4 years, because or 8 years, whatever it is, depending who goes in, because they've all run away. They've literally all scattered. And Draghi has conveniently organised that his tapering will end the day before he leaves ECB, quite literally. So he's going to scarper as well, and I'm sure Mark Carney is going to do the exact same thing with the Bank of England. So we've no idea what the policy is going to be. We've no idea who they're going to be who's going to implement these things, and we don't know where we're going to be politically. And the big risk is that vacuum is going to cause a lot of volatility and changes in policies. I mean, and it'll be interesting to see.
You could argue, in answer to your question, we do know exactly what's coming next, which is what I just meant, which I mentioned earlier, which is you will have versions of modern monetary theory and helicopter money. That is exactly what's coming down the track, and you will probably.
German Weimar Republic solution.
We've run this experiment before. Why do we think it's going to end?
With all due respect, we didn't run that experiment. But the other argument is that you'll probably end up with fiscal policy, which is the governments will basically step up to the plate and they'll do stuff. They won't just leave it to the central bankers, and the government will basically force a form of Keynesian re-engineering. I mean, I'm not arguing that.
You're assuming that the government's smarter than central bankers, and while I don't agree with central bank policy, I think that's a big stretch.
I think if you've got millions of people unemployed on the street, I think they have no other choice. But anyway.
What do you actually understand by helicopter money?
As a mandated bank account, the argument that's being put forward is things like mandated bank accounts that are given to lower income families so that they have a time limited period. Using electronic money, it's an idea that's been kicked around. But I might point out, electronic money is actually originally Milton Friedman's idea from the monetarist argument. It's not just an argument. I'm not justifying it, but I'm just trying to explain it.
No,
but
the description of it doesn't make sense, because if you say you just give everybody an account and
yeah.
you get money out of it, you have no way to control for the balance of payments. The way helicopter money would actually work, right, is that a central bank or a treasury will issue a zero coupon perpetual bond.
Yep.
Central bank will buy it. Central bank then gives that money to the government.
Yep.
The government can spend it accordingly. Right? But the idea that everybody just gets a check in the post, that is not helicopter money.
This idea, like the Norwegians talked about the €800 per month. Yeah, Milton Friedman's was slightly different.
I suppose so. There are variations of the model.
The technicalities of how banking works today, vis-a-vis in the 1960s, has changed somewhat.
So there are MMT art theorists who do argue for the version I argue for, and Krugman's quite correct argument, his argument back to them was it wouldn't allow for balance of payments and it would actually completely destroy the system and it wouldn't work. But I'm not justifying. I'm just simply saying that is what the argument.
Negative rates, so where are they going to go?
Yeah, I'm just saying that is clearly what is being thought about at policy level. Any other questions? I think, well, we're coming to the end. Time for drinks is coming up. Well, look, it's quarter to 8, so we've only had a mere hour and a half. And I think we've probably put the worlds to right, or even wrong. And let's carry on the conversation outside. Thank you very much for coming along. We'll be putting this online as well, so if you want to go back and recommend it to your clients and people you talk to, you could do that as well. And thank you very much for coming along this evening, and hopefully we'll see you again soon, and we'll be talking about another big subject. Thank you very much for coming. Thank you for our panel.